Well, it turns out it's all relative, isn't it? And relative to the market high last April, we are slightly less overvalued than we were then. So that's an encouraging trend. Relative to most of history, however, it looks like stocks are either, at a minimum, they're at least fairly valued, and according to some measures, they're actually quite overvalued relative to history.
Right. Now, let's first take this issue about versus last April. And basically all the analysis is saying is, listen, we've had another year of earnings under our belt. Earnings have grown a little bit. So on a sort of ratio basis, looking at PEs or other multiples, the market is not as expensive because we're at the same level as we were last year.
That's right. I mean, we talked about a lost decade earlier this year and last year. Of course, this is not a lost decade. It was a lost 10 months rather than 10 years. But you're right. We're back to exactly where we were at the end of last April. Earnings have come in so that any PE ratios that had earnings in the denominator is going to have an improvement over that period of time.
Now, Mark, when you put in your piece again, which folks you can check out on marketwatch.com, when you put in your piece that the market is still overvalued historically, you're using Robert Shiller's method for measuring PEs, correct?
That's right. He looks at what he calls a cyclically adjusted PE that tries to take into account the fact that, especially at bear market bottoms, just the straight PE ratio is very, very unreliable. In fact, in March of 2009, 3 years ago, the PE ratio looking at trailing earnings was, depending on exactly which slice of the earnings you were looking at, was over 1,000 to 1, suggesting the stock market was overvalued, or of course it was actually quite undervalued. So it's trying to overcome some of those cyclical swings, and that's why it's called a cyclically adjusted PE ratio.
Right. But isn't it true also that in looking at this cyclically adjusted, by looking over a longer period, in this case, by looking today, we're also taking into account two kind of very aberrant periods within the last decade. The first being the internet boom and bust. And when it busts, earnings bust quite severely at the same time. And then more recently, with the financial collapse or crisis of 2008, 2009, again, you had very aberrant earnings. So if you take those into account and you use that part of the analysis, won't that tend to color the results?
Well, that's right. I mean, to the extent that you think the last decade is unusual, therefore you would tend to discount any conclusion based on what's happened over the last decade. However, if you go back and look at the data to the late 1800s, that's where Shiller's data dates back to. In fact, it begins in 1871. There have been a number of decades in which there have been at least 2 recessions. So the fact of 2 recessions and 2 bear markets over a particular decade is not particularly unusual. If you go back to include the 1930s in the analysis, then perhaps the last decade doesn't look all that unusual. I think it's always a bit dangerous to say that somehow that what we saw the last decade is historically unique and therefore we need to avoid the analysis. If you include the entire data set and use it to predict where the market is over a 10-year period, it's a very long-term forecasting tool after all. It has a far superior track record than does the normal PE ratio.
And yet, if you look at the normal PE ratio, by most measures, and let's just assume you get an earnings level of plus or minus $105 for the S&P 500, you're looking at the S&P 500 being priced plus or minus 13 times this year's earnings, which you ask most people in a historical context would be seen as come across as quite reasonable. Do you think I'm getting that right?
Yeah, that's right. I mean, if you look at just the straight PE ratio, according to historical norms, we're more or less right in the middle of the range. That's to say neither over nor undervalued. So if you look at that alone, you reach a different conclusion than you would if you looked at some of these other valuation measures like Shiller's.
Right. Now, Mark, final question for you. In all this analysis of the numbers, you're not using a comparative analysis. You're not looking at stocks versus bonds. Do you think looking at these kind of PE ratios on their own without taking into account the inflationary environment or the relative return you could get, say, on bonds, don't you think we're missing a big part of the picture here?
Well, you know, that's a very controversial issue. It turns out that if you go back and look at the last 130 years and try to introduce into any econometric model the prevailing interest rates, like you're suggesting that perhaps we ought to do now, it turns out that it does not improve the forecasting ability of the model. So even though theoretically I couldn't agree with you more, why not take interest rates into account to look at relative valuations vis-a-vis bonds and other things? It tends to, historically at least, not to have improved the forecasting accuracy of the model, and therefore I'd have to at least raise the question of whether it really is something we ought to be doing now.